Hello and welcome back to Talk Finance. This time we grow together. So in the previous video, I discussed price and time using examples such as inflation and a low risk investment product, which is a fixed deposit in a bank. And I mentioned that Standard Bank offers a fixed deposit below 10,000. You can go further in your research and compare bank investment products and open a fixed deposit account. The sooner, the better. This allows your money to grow in a safe environment and you can learn about investing in other environments like shares or stocks with no pressure at all. Now let's move on to price and time when it comes to stocks, stock market or in companies. So what I have here is the price chart of Devon Energy Corp, a company in America. And I have it in my 1 year portfolio and I'll be using this in my ongoing explanation. Even companies you know very well are all here. Standard Bank, ShopRite, Old Mutual, just to name a few. They all have prices reflected. So back to Devon. You can see how its share price has moved from 2018 up until today. From $40 down to $5, then up to $79, back down to $4.50. So to give a total unrealistic example, if you have 10,000 and invested in Devon when the price was at $5 and you then sold your shares at $79, that 10,000 would have grown to 158,000 in 2 years and 3 months. But because there's no such thing as a perfect investment, back to reality. So just like you put your money in the bank and getting an interest rate of 8% per annum, which means you are guaranteed an 8% return. When you buy a stock at a certain price tag, there is a number that price must rise to in order to make a certain percentage of return. So the first step is very easy. What's the inflation rate? 6.1%. I always take the highest number, whether it's service inflation, core inflation, or core goods, whichever figure is higher. So now I know that for the year which I'm investing in the stock, it has to rise by 6.1% minimum for the value of my money to be retained. Secondly, I look at bank interest rates. I see that it must rise above 8.7 or 9.06%. But for me personally, I put it at 10%. But I know the figures, which is important. So these levels are important to note because you will like to perform better than the person who is investing in the bank if you are investing in the stock market. And also to retain the value of your investment because unfortunately, inflation will be eroding its value. So looking at Devon Energy Corp, it's at 4.8%. This is my Easy Equities account, which I bought Devon Energy Corp. So 4.88% means that it's still below all the levels I have mentioned. So I'll be content if the investment reaches 6.1% by the end of the year. I'll be satisfied if it reaches 10% to 19%, and obviously blown away if it reaches 20 to 40% by the year's end. And to calculate these prices, when we look at the average price that I bought the shares was $44.12. So if I'm aiming for a return of 20%, I simply multiply 44.12 by 11 plus 20 divided by 100, which will give us $53.6. So this particular investment must rise to a price of $53 for me to get a 20% return within this year. For 40%, it's just plus 40 divided by 100, and that is $61.9. Will the investment reach that target? Only time will tell, and you will have to stay tuned to track the progress. Now I'm going to translate this information in an illustration. So this is return versus time. And we have the return target of 40% and the time target of 1 year. The line in white represents the optimum scenario whereby it takes exactly 1 year for the investment to reach 40%. The less desirable scenario is when the investment runs out of time before it reaches its return target as shown by the orange line. Note that doesn't mean it's a bad investment. It simply means that it underperformed your expectations. So the investment ran for a full year and obtained 20%. Now the perfect scenario is when the investment takes a shorter time to reach its return target. You saw some potential in a company and invested first, then there was a huge demand for its shares. As more investors bought shares, your return rose to your target in a shorter time than expected. So I said earlier it would blow me away if my investment reached 20% to 40%, highlighted in green. Then I would be satisfied if it was above 10% and content if it beat the inflation rate. So this is one way to set your investment targets looking at inflation, bank interest rates, and also include bond rates and dividend yields as well. So tell me what you think about the lesson. Did you find something new? Maybe you heard of these terms before and it triggered your memory, and hopefully you enjoyed the content. Subscribe to not miss out on it and give a thumbs up. It will help put the channel out there for many viewers to see. Thanks for your time, and I will see you on the next one.